Morning and happy Monday, April 11th, 2022. Dave Galloway, CEO of Heartland Home Mortgage, with your Monday Mortgage Heartbeat. This week we're going to be talking about when the Fed raises rates, how does it affect me? A lot of times we get a question, you get the news, and the Federal Reserve, which has rumored to be increasing rates, everybody worries, says, okay, does that mean my rate's going to go up? So obviously, if the lending rates are going up, interest rates are going to go up, but it does not affect it instantaneously. The way it works typically is lenders and banks already have an inclination on what they think or predict that the Fed's going to do. So if they predict the Fed is going to bump lending rates by 0.1%, so 0.1, they'll already, usually at least 2 weeks in advance, kind of bump interest rates. Now, the immediate effect sometimes can take place if they assume the Fed may be raising rates by 1/4 and they only raise it by 1/10. Thus, the day after rates actually go up, the Fed rate goes up, our rates a lot of times will decrease because they projected too high of an increase, or it can go the opposite way. So a lot of times we'll get a phone call the day before the Fed's going to raise, or the day the Fed raises, says, well, how does this affect my rate today? It doesn't have that instantaneous effect. It's already been built in 2 weeks in advance. The other thing is that if you already locked in your rate, obviously you're in great shape. One advantage we have here at Heartland is we have several different investors. So if we lock your rate and then rates decrease, we can actually renegotiate with our investor or switch investors and get you a better deal. So you're kind of locked in with that worst case scenario with the opportunity for it to increase in the future. So you have a little bit more knowledge now when the Fed raises or it decreases rates, just how the market affects. Have a great week, and we'll talk to you next Monday.